Asia-Pacific markets are mixed after the Federal Reserve Chair Jerome Powell said inflation in the US still isn't coming down to the bank's 2% target range. That's dampened hopes that the bank will begin cutting interest rates anytime soon. Now, Japan's Nikkei has dipped, with the topics seeing a larger loss of just over 1%, while business optimism dipped. And South Korea's Kospi extended losses by falling almost 0.5%, contrasting with the small-cap Kosdaq's gain. Singapore's non-oil domestic exports have plummeted by just over a fifth in March, significantly missing economists' expectations of a 7% decline. Meanwhile, some good news out of Japan for a change, as the country's exports rose a little over 7% year-on-year in March, exceeding expectations. Imports fell compared to the previous year, and Japan's trade surplus climbed to $2.3 billion, surpassing forecasts. And on Wall Street, the Dow Jones Industrial Average rose after Powell's comments, while the S&P 500 and the Nasdaq both slipped. The two-year US Treasury yield briefly spiked above 5% following the Fed chair's remarks. Well, let's get more on this now with Mike Ingram, who's an independent market strategist. He joins us now from London. Good to have you with us, Mike. All eyes, of course, have been on the US Federal Reserve and whether or not they'll begin to start cutting interest rates. But it seems that Jerome Powell has put a little bit of a dampener on that, hasn't he?
Yes, indeed. And actually, it's only the latest episode, almost a 180 from markets in their thinking about where interest rates in the US are going. We came into the year with the market very much discounting between 5 and 6 quarter-point cuts during the course of 2024. Only a week or so ago, that had been revised to 3 quarter-point cuts in the second half of the year, maybe starting in July. And if we look at the situation now, the market's thinking, well, maybe the first cut's going to come in September, and maybe just 1 or 2 quarter-point cuts during the course of the year. So, and all this is as a function of a US economy which continues to outperform on growth, but where inflation is also remaining quite sticky. If you look at core inflation, the most recent number is 3.8%. So in Powell's own words, perhaps not quite so confident that they've beaten the inflation beast quite yet.
Well, that's right, because the fact that, as you say, inflation in the US still is a little sticky, it hasn't reached that 2% target that the Fed has long held. It is a sign of the strength of the US economy, isn't it? We're seeing strong employment figures in the US market, as well as GDP growth. That ultimately is a good thing, isn't it?
It is, but of course it makes life quite difficult for policymakers. And I would point out in the case of the US is running a budget deficit of something like 6% of GDP. So fiscal policy is also playing its part in making the economy more robust. And ultimately, I would say that's unsustainable. But also the broader backdrop actually is most economies are proving to be rather more resilient in this higher interest rate environment. And the IMF's most recent review, they've actually upgraded their global economic growth forecasts.
When we look at Asian markets now, Japan in particular, we've seen an uptick in exports, which is always good news for that export-dependent economy. But domestic consumption is still a problem, isn't it? The Japanese simply aren't spending enough in order to bring inflation up. We're seeing interest rates for the first time get out of negative territory. But domestic consumption is still a problem for Japan, isn't it?
Yes, indeed. I mean, the Bank of Japan recently abandoned its yield curve control, and it is tapering its QE program quite aggressively. I mean, the trade numbers that you mentioned, yes, exports are up 7.3%. And a large part of this is resurgent exports to destinations such as China in things such as autos and electronics. On the other hand, export volumes are down by 2.1%. So you're really seeing the impact of the weaker yen in pumping that headline number up. And you look at the import side, well, imports are down by 4.9%. And if you look at services of manufacturers and service sector providers, they're actually relatively downbeat about the prospects effectively for the domestic economy, because a weak yen reduces the affordability of imported products. So, we have seen this big change in policy from the Bank of Japan. I have a horrible feeling that maybe it was premature, and perhaps Japan hasn't quite got to that point where it's in this virtuous circle of increasing wages, increasing demand, and inflation's at their 2% target.
Okay, Mike Ingram, we'll leave it there for now. Always good to get your thoughts. Thank you.
Pleasure.